Hello, Warriors. Mainly another day of range trading in FX, except the performance in the yen. Canada yesterday, for the most part, probably evening up, waiting for the consumer pain index tomorrow. How are you, Alexander? Sinatra, Mike, how you, Bran, Ryan, AJ, James, Esther, welcome to Faith. And Patrick Bulger, how are you? So I'm going to start off with Brian. Some pretty good strength. Little pull. All this was a pullback. You have some levels, buddy, and good morning or good afternoon to you.
Yeah, good morning, good afternoon, mate. 146 is the next level up above. Looks like we're finally getting above this 145 area, which is pretty important itself. This is all yen driven at the moment.
Okay.
That's the biggest take from this.
All right. And yields aren't really following, are they? So,
No, exactly. The
yeah,
correlation's split.
yeah, because we're just sideways here in yields, except maybe a good candle. I think the whole week is made tomorrow, right? You were right on Monday. All we had to do was come back to tomorrow. Right?
Yeah,
I
well,
mean,
it was the same on the NFP week, wasn't it? Yields did nothing
yeah,
until the NFP, then had a little flip around, and I think it's going to
yeah,
be the same. The market's happy with its price, its real pricing for Fed expectations, and now the data is just going to confirm or deny those thoughts.
So what do you think of this, Brian, with the, everything that's going on and, 6,000 targets in the S&Ps? This looks like it's a failing rally to me in S&Ps. Of course, be helpful to take out this 4740 level first. And then yesterday, when I commented that uh, NASDAQ 100 hadn't even traded to 61.8, it did that yesterday. And, this too looks like it could be a failing rally to me.
Yeah,
So, I mean, at least you're pretty close to where you'd be wrong, right?
yeah. I think it's another one with all these earnings coming out. It's playing the wait and see game. If we get
Yeah,
stellar earnings, then we're going to take out those highs. We're going to go. We're not going to blink. We're going to be through those.
yeah,
I'll be very surprised if the S&P doesn't take out its highs on strong
yeah.
earnings. But then
Okay.
if they're weak, we'd probably do the opposite, and then you can put it down as a failing rally.
Yeah, I was kind of thinking, A, B, C, maybe
Yeah,
down to 46, 540, and then we blast again. And NASDAQ, if it fails from here, um, 1.618 would take it to, I think I have it on the weekly, where I have this black line drawn. That was an important level,
yeah.
around 15.4. So almost like we have the cookie on the weekly, right?
And
Or
I
Blake?
don't think many people want to put their neck on the line with all these earnings coming out.
Yeah. All right. Well, the dollar, I mean, any bias, you think that was enough? Earlier in the week, I thought that, we could get a correction. We will have a 2 week reversal. It's not going to take much in the dollar closing over 101.50, but earlier in the week, I thought there was a chance that we could, pull back down to maybe, 101.5 or so before we go.
Yeah,
But looks like if we could start closing over this moving average, we're going to just head up to, I think this is going to measure if you just call it, I don't know, 270 and call this par 60 and tack on 2 from here. It gives you 104.70, which
yeah,
was, which is what back here when I thought that we would get a bottom, that was a target. That's 61.8 back. And now that's what's interesting about the market. So you could have a level that you think the market could get to,
yeah,
but it's really just, a fib number. But then as you see it evolve and the process go through and they give you ranges, then you have the ability to measure things. And then when it measures to levels you were thinking about back here, it even gives you more conviction about the narrative.
Yeah, it's another bit of confluence, isn't it, to the armory
Yeah, it's
when
like
your measurements start matching
you have
up.
evidence. Down here, you have no evidence of where it's going to go. You don't even know if it's really going to be a bottom. But you say, if it is a bottom, this is where I think it could go to. And then as the market progresses, it gives you geometry that ends up measuring to that level.
Yeah,
I think that's pretty cool. Maybe that's why, after all this time, I'm so fascinated by these markets. So it's the best
absolutely.
jigsaw puzzle, and we don't have to go to Disneyland. We have financial Disneyland every day.
Well, it was circus land yesterday with Bitcoin, wasn't it? Yesterday evening.
Oh yeah, that uh,
What a shit
whoever
show.
engineered that, you think they made some money?
Yeah, someone's made some money there. I'd bank on that. It's too set up not for anyone to have not made money on that. I mean,
You know what's
how can you release a tweet? You're
yeah,
the SEC, your government office, and
yeah,
someone in your office releases that tweet. I mean, that's
yeah.
unforgivable.
And we thought it was going to be the fact, but it was a rumored fact, and it still peaked on it.
And it cleared everyone out. It cleared the
Yeah,
longs out, it cleared the shorts out, and now everyone's skint and probably a bit more scared to get back in. And because that's the second time we've had this, rumours and then Scotch rumours, or the
yeah.
last rumours were that it wasn't going to be approved, and then that got poo-pooed. So yeah, there's a lot of people who are front running who are doing their arses on this, and the old saying, once bitten, twice shy.
I was reading someone's tweet. The guy's always a bear, but he said every major sell-off correction that we've had in the market over the past several years starts with something with, like, when Bitcoin, when they introduced futures, that was a high.
Yep.
The guys just wanted a contract so they could short it. I forgot the levels, but
Sixty-five
um,
thousand, I think it got to, didn't it?
yeah,
65.
yeah, yeah, that was
So,
probably it. Yeah,
and I'm expecting the same reaction here when the ETFs get approved. Everyone will go piling into it. You'll get a new high, and then everyone will do the what do we do now? Now that everyone's long,
yeah,
then the
yeah.
rug gets pulled out.
Maybe. I
I'm
mean,
not
it
saying it's
looks
going to
like
65
it.
again, but it's definitely gonna rally as you get all the people who don't want to get directly into coins will get into ETFs.
Yeah. Okay. So I guess we should talk a little bit about WTI. Yeah. There you can't find a bull anywhere, but it's trying to hold here. Maybe we get a pop. Um,
Yeah, I'm surprised it's not much higher on all the geopolitical risk going on over there.
yeah, I
But
saw there were the Houthis are firing missiles. I don't know at what ship, at what target, but they're still firing.
yeah, it's not really dragging in the major oil producers, is it? So that's probably why we're not seeing that much of an effect. If America goes to war with the Houthis, it's not going to impact oil that much, just shipping, which
Well,
it already has.
I'm hearing people make comparisons to uh, shipping having to go around Africa, that route, and the shippers have been going bananas because of the rates they're charging right now. That
Yeah,
this can also turn into a supply chain issue, because of this disruption of a major route. Anyway,
yeah,
just you know, be like an echo of what happened in COVID with all the supply chains. Then, we couldn't unload the docks. Now they can't get to the docks. So,
yeah.
or it takes them longer. Anyway, silver's still on its back foot, like we had diagnosed. Gold as well hit Blake's head and shoulders target, but it doesn't look that great to me. In fact, my target in gold is down here around 1900.
Whoa,
Um,
whoa! Is that a new target for you, Dale?
no, I've had this line here for a long time, but I didn't want to think about it when it was,
Yeah.
doing this and this. But now it looks like, it's possible that we just get some kind of flush here. That would be near 78.6, and that would be, a back up the truck move for me. Miners, and also there's an important cycle in miners that they're all supposed to bottom this year, and then they're good for about 2-3 years. Newmont got hit up here. I was saying I still thought we could pull back to 36. They're having trouble at a mine, but even the ETF GDX doesn't look that good. Under 3, this could make new lows. Here's the silver ETF. It looks vulnerable too. Maybe we're going to attack this, especially if we get to what Gregor was talking, under 22. You have that triangle, Blake, at 21 something. So I think we're still like $1.80 or $2 away, right?
Let me pull that up.
Yeah,
Yeah,
well,
yeah. It's
180.
I have it at 21, like 21.25 ish,
All right.
roughly.
So
Yeah.
that's a lot to take out of silvers. So when the physical gets there, I'll be buying those miners. Okay,
Yeah.
I wanted to be I was patient for a long time in this one, and then I have one more to show. This one demonstrated the most relative strength. It was about a 80%, 70% move from here to here.
Yeah.
And I was thinking 320 to 3. But look at this as a kind of, I call it a dark horse because it was relative weakness. But look what it's, you know, uh, setting up all these divergences. And this is pretty cheap when you look at where it was, in 2021, it was $7 stock. So tempting, diverging on the weekly. This is kind of a dark horse for silver spec. And even last year was 350. So, that's more than a double if we get back up there. So that's Endeavor. So these are the two I like.
Okay.
Fortuna.
Can you zoom out, and is that it? Oh, that's it. Okay.
Oh, no.
That's a weekly chart.
Zoom
It
out
looks
on
like
this.
yeah, I mean, it looks like a big, well, what chart were you just on? Like, go back. Oh, is that the daily or weekly?
That's a weekly.
Oh,
So maybe it was a daily that I was showing. Yeah.
Yeah. I mean,
You
it looks
mean
just like
this?
a big range. So, yeah.
This looks
Okay.
like a wedge, doesn't it?
It does, but the weekly looks like more like a range. So, yeah, you can play it on the long side somewhere down there. Huh.
Yeah.
Interesting.
Anyway, just a couple of silver. If you're a silver bug and you're thinking about getting long physical, some other ideas.
Awesome.
Okay.
Hey, and good morning, guys, and good morning,
Morning.
Ryan.
Morning.
Hey. You guys were talking a little bit about crude. I do want to pull it up because just a moment ago, well, actually, just before you started talking about it, maybe about 2 minutes beforehand, if you look in the ForexAnalytix chat room, I posted, this chart, and I'm like, hey, crude's at resistance right now. That was while it was
Nice.
above $73 earlier this morning. I was talking about 73.30 being resistance, and then all of a sudden we just popped up there, hit it, and reversed. And as we were talking about, I'm actually quite surprised crude's not higher right now, but it is being contained, and this resistance is really critical today. Now, maybe it is going to be a product of CPI versus geopolitics. I mean, everybody thinks that maybe it's going to be a geopolitical move that drives crude oil, but who knows? All I know is higher crude is not going to be good for risk. I think it's going to be one of those things that if you start to see crude really percolate higher, you start seeing us above the 50 DMA, you start seeing us closer to the 200 DMA, it's going to weigh on risk a little bit. But that hasn't, obviously hurt the market as of yet, because the market's still holding very well above 4,700. And the 4,700 level continues to be really critical support for the S&P. Below that's the 4650. 46, 45. While we're above there, no reason to be bearish at all. But also I have to say that the dollar's holding up relatively well, considering. And tomorrow's inflation data is what everybody is waiting for. And if you can't see it here, what I've been hoping for to set up this whole week is to be setting up a head and shoulder pattern. And I've been waiting for a dip down to 102 to get long dollars. But hey, maybe the 109 or maybe the euro dollar can trade up towards 110, excuse me, today. And that would give us an opportunity to be on the short side of the dollar up at those or on the long side of the dollar, excuse me, down at this level if the euro popped up to 110. I just don't know if that's going to happen. I'm hoping it's going to happen. But that's kind of the setup that I'm looking for going into tomorrow. And what do you make of the inflation data that we got out of Australia last night, Ryan?
Yeah, a little bit softer. Again, it's one of those ones you can take in two different contexts. Yeah, it's coming down 4.9 to 4.3, I think it was. But it's still well above target. It's still got a 4 handle on it. So, yes, it potentially keeps the RBA on their hands because inflation's going the right way, but they'll still be mindful that it's not coming down fast enough. So that will keep them, middle of sitting on the fence, shall we say?
Yeah, I mean, and the Aussie, the reaction in the Aussie dollar was, first it was down a little bit, and then it kind of popped back, and not sure why, because Europe, just I guess played into it, but the Aussie still, I guess, pretty sideways.
Yen as well. Look at all the yen pairs. Aussie yen. The yen is holding up, or yen pairs are holding up all the majors at the moment.
Yeah, and that should take us to the chart that I posted on Twitter today, which is the Nikkei. I mean, the Nikkei is ripping. Did you see that, Dale?
Yeah, it's making new highs.
Yeah, I mean, yeah, we're breaking out into levels we haven't seen since 1990. What were you doing back in 1990?
Cruising.
Was that the Gulf War one?
I joined the Marine Corps in 1990. Yes.
Okay. So that was it. So I had my own IB, and I was selling gemstones on the side with a company too.
Wow.
So I've done everything.
Wow. Gemstones and everything. That's crazy. Yeah, 1990. I mean, that's the last time that the Nikkei was up here. What's that?
I was crazy back then too.
I bet you were. Well, if you would have caught me in Southeast Asia in the 90s, we would have been crazy together. That's for sure. Yeah. But look at this. I mean, it's an amazing move, right? I mean, you look at 30 years lost in Japan here in the Nikkei. Pretty wild, but it is breaking all-time highs, or not to all-time highs, to multi-decade highs, and taking the yen with it. So as you pointed out, Ryan, you got these yen pairs that look really quite constructive. The euro yen's at the underside of this broken channel. I should probably get rid of this. We completed this equal leg move a long time ago. But you can see, we're just challenging the underside of that. Where the pound yen's trying to break higher towards resistance. We're at the 618. Aussie yen up against triangle resistance here. Kiwi yen up above resistance slightly, and then the Canadian yen is making itself higher in the channel right now. So really, you're right. All these yen pairs moving higher, and you guys pointed out this morning, it hasn't been a yield story. I mean, we have 10-year yields are actually just kind of consolidating. We do have a 10-year auction today, though, and that's something that I think that we have to be paying attention to today, because I think there's 30. Let me figure out that number.
The 3-year yesterday went off without a hitch.
It was a really strong auction yesterday, and then today I can't remember. It was like 32 billion. Where it's you know, a lot
Something
less
like
than
that. Yeah,
10-year, but
it's been a good start for auctions. I noted that on the flow show. I mean, Dale picked up the UK auction yesterday, that strong 20-year auction. Europe hit a record-breaking day, 43 billion going off. So there's a big appetite for bonds. I think
well,
what the
that's
commentators are saying, people are locking in those higher rates before the cuts.
right. That it's the alternative. What you didn't have an alternative, you know, that, and that's an argument with a lot of macroeconomists is like, you know, the argument or against, excuse me, equities at current levels. You're like, okay, you know, I can take on the risk of buying stocks up here, but I can also, you know, instead of trying to hopefully squeeze out a few percentage points in the stock market, I can just roll my money into fixed income and make some money there. And I think that's probably going to be, you know, I know Dale, you're going to have Lakshman from Business Cycle. He's going to be on today. And I bet you that's something that he's going to be talking about is, you know, yields and alternatives to being in the stock market right now. It's going to be an interesting conversation you're going to have with him today.
Yeah. Looking forward to it.
Yeah, I think it's going to be a great one. Hey, real quick, you guys are talking about precious metals. Let's go take a look at them. Just because I still I'm doing an event this weekend and I'll be focusing on gold and I'm going to pull up a few charts with yields and gold and whatnot. But I have to say that gold, even though it completed this head and shoulder pattern that we had last week, Dale, you talked about it. It can't get back above the neckline, and so it still is trading pretty heavy. And I'd be a little worried, especially if we have a strong, strong inflation print tomorrow. If we do that, next thing you know, you're going to have gold trading below like this 2010 level, and we start breaking through 2010. We're going to be trading back below 2000, I think, pretty quickly. And then you're going to see, you know, some of the air come out of gold. And I think some of these longs that have been just parked in gold longs, I think are going to, you know, be a little pressured. But as you pointed out, Dale, I think buying dips is going to be important. I don't know where I want to be a buyer, but I know it's not going to be near, you know, while it's above 2000. That's not where I want to be positioned.
I think you'll see 1900 print, maybe lower.
Yeah.
So,
I don't disagree with you there. And then, you know, going back to silver, here's that, you know, I know it's a big conversation we've had. I know a lot of people don't want to hear what I have to say regarding silver, but, you know, that false breakout tends to lead to a breakdown. And yeah, your first stop is going to be here at $21, $21.30. We get below that, and that looks dangerous to me. And I don't like necessarily want to short it. I'm just looking for places to get long. But if we do break below $21, that would be a pretty negative event, I would feel for silver overall. Something just to be paying attention to. I'm trying to find places to be long, and I just know it's not here, and I know it's underperforming gold at the moment. One of the other things I wanted to bring to your attention here, let's go here. If you're in the ForexAnalytix community and you go in the trades room, you'll notice that I just got long the dollar CAD, a third position at 133.70. I actually had a bid last night to buy, and I mentioned this in the general chat room, you know, before I took off for the evening. So if you go all the way back, you know, you can go ahead and fast forward all the way till yesterday, which you have to keep going through here. I told everybody before I left, I'm like, look, I'm putting a bid in, you know, for the dollar CAD in the 60s overnight, because this dollar Canadian is very, 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 first of all, it's very strong, and the dips have been very shallow. 134 is a big pivot. HB, who's one of our traders in our chat room, he's like, you know, hey, Blake, do we, on a, you know, when we get above 134, do we buy it? And I'm like, it's hard to be a buyer of the dollar CAD when you have risk appetite that is as strong as it is. Although it is holding up well, you can't just buy it on rips. You got to buy it on dips. So, you know, like I said last night, I'm putting my bid at 133.60s, and it missed my bid by probably 2-3 pips last night. And when I got up this morning, I'm like, This damn thing dipped right into the 60s, but my bid was just a few pips below. Didn't trigger me, so I got long because I think that we're going to eventually break out here in the dollar CAD, especially if crude oil can stop here today. And I've got fingers crossed that crude oil is not going to, start taking out 74, 75 bucks. If that happens, then dollar Canadian should succumb to some selling, I would think. But I've been talking about this pair for the last week and a half on the week ahead videos. I wanted to be long down here at 131, couldn't get it. It has been insatiable buying in the dollar CAD, and dips have been very shallow. So what that tells me is it's not letting buyers in, but more importantly, it's not letting shorts out. And if you're short the dollar CAD, you are not getting the dip that you're wanting to get, because you keep looking at it. I'm speaking on the behalf of somebody who's not wearing the other shoes that I'm not wearing. They're looking at the dollar CAD. They're like, oh man, if I can just get a dip down to 132.50, I'm gonna buy it. And then another day goes by, doesn't dip, doesn't pull back. Like, well, if it could dip below 133, I would take it off. I missed my chance here. I'm going to do that. And it doesn't do it. It just continues to grind higher. Like, okay, well, if we can get down to 133.50, I'll buy it. I'm just going to cover what I've got short. And now we're getting to a point where it's going to just start squeezing. And that's the dangerous part. If you're short, is you're getting to that point where it's going to be, nice and squeezy, lemon squeezy above these highs. When we start squeezing above that, and especially on a strong inflation print tomorrow, if we get one, the dollar CAD could be trading well above its 200 DMA by the end of the week. So that's something that I think that you guys should be paying attention to. I'm already staking my claim here, and
35 minimum, Blake.
Yeah, I mean,
and 36 is possible too.
Sure, this is one of those pairs that's acted pretty well. You could argue the same about the Aussie. If you chase this Aussie higher at the end of the year, you're looking at it going, damn, I really paid up for that damn thing. If it could just bounce back to 68 cents, I'll get out of it. Or, if it could get back
to puke at 65.50 and
then
at a bottom at 65.
I believe below this 38% retracement right here at 66.40. And you have the 618 retracement of this move that's at 66.60 right there. You break below this little,
I think you're really onto something, Blake, because remember on the way down, I just kept saying, God, it's weak. God, it's so weak. And then it was the first to turn day before the dollar. So Canada seems to be leading the way. It's kind of like a harbinger of what the rest of the currencies are going to do. So, as long as
like
that's
the canary
working
in the coal mine for some people, and so this is one that I think
bird.
It is a loony bird. We just got to keep our eye on it. Like I said, I finally gave up. I'm just like, okay, and I actually bought it a couple of days ago and ended up spinning out of it for a couple of pips. But it's one of those that I think we got to keep an eye on, especially if you're trading the dollar. It just looks good. And if you want to trade a cross rate, one of the things I want to keep an eye on is this Aussie Kiwi. It's nearing pretty key level support. I was looking for a dip. You can see I have an alarm set there. I was looking for a dip down to 106 80s if we could get it to be long in this triangle. Again, I played it down here a couple of weeks ago, and I'm gonna try to play it. That was in December. I'm going to try to play it again down here. Again, if you're just trying to, remove the dollar out of your equation, those are opportunities too that I think are setting up in the FX market. So, hey, Dale, before you bring in Lakshman, what do you think about this VIX? We talked about this, VIX, it's still trading really weak. Thought it'd peek its head up and it hasn't yet.
Yeah. I'm long. That's what I think. And I tell you what, I feel like Job. You remember the story of Job, Ryan?
Vaguely, yes.
He was he was tested by God, and he lost his family. Huh?
Steve
Steve
Jobs.
Jobs.
Steve Jobs.
Yeah.
That was it.
Oh, that guy. Yeah, he had a he had a different Job
He had a
experience.
good
But
idea.
anyway, no, I mean, magic. He had magic in his garage. What can some people just have that. They're born under some type of real miraculous
Full
sign
moon.
that everything works. Yeah, I don't know if it was a full moon,
All right.
but
Well, hey, I know you're gonna bring in Lakshman right
he's
now,
not
and
here
I
yet.
just want to say, if you guys haven't checked out the ForexAnalytix, check out ForexAnalytix. If you want to learn how to trade or trade somebody else's and not risk your own capital, check out the Trader Funding Program. If you haven't checked that out, make sure you take a trial of
There it is.
ForexAnalytix and jump in the chat rooms with Ryan and myself and K-Man. He'll be back on Wednesday, and we're all in there keeping each other's company as we're waiting for CPI. And I'm going to let you take over from here, Dale.
All right, so I just got Lakshman
Were you
just
able to promote
arrived.
him?
He will be rejoining as a panelist.
All right. Very good.
So,
and he is here.
Lakshman, Happy New Year.
Oh,
Happy New
hi.
Year, Lakshman.
Can you hear me okay?
Hear you and got your picture up
Hi,
there,
Dale.
and
How are you?
you're fine. It's really nice to be talking to you today, Lakshman. I
You
mean,
too. Happy New Year. I was muted before when I said that, so I'm repeating
okay.
it.
All right. Well, speaking of New Year's, I'm been looking forward to hearing what your narrative is, and with everything that's kind of changed in the last couple months, at least interest rate wise. Tell us what you're thinking going into 2024. Has your forecast of a hard landing been revised? I mean, you might be the only one left if it hasn't.
Well, I'm open to it. I
Okay.
haven't seen last time we spoke, Dale, I'm sure I was talking about the tug of war between the cyclical forces to the downside, and those actually persist, uh, being offset by these non-cyclical um, elements that really came to the fore in 2023. And by non-cyclical, I mean uh, you could have something big and structural like what happened to the labor market with labor market shortage, or you could have a lot of one-offs, policies or injections of spending that um, are they don't look persistent. They look like one-time events.
Like
Uh,
COVID responses to COVID. Is that
those
what
kind of
you're?
things, right? So
Yeah.
stimmy
Okay.
checks or some of the fiscal spending. Um, if you look at kind of the ebb and flow of the size of the deficit, for example, the kind of deficit spending that we've seen um, over the last couple of years is the type you would see inside of a recession. Right. So
Okay.
typically that kind of government push happens in reaction to a recession. Here it is happening perhaps before, because we have, there's been some pretty big
Yeah.
spending packages that have
Still
gone
in the
out.
pipeline. The
Some are still
inflation.
so much
Yeah.
that the pipes got clogged, right? So it didn't all, there weren't enough so-called shovel-ready kind of places to put them, to put the money. And so I think some more of that'll happen in 2024. Maybe they'll push some of the money that wasn't spent out to state and local governments, that kind of thing. I think that'll probably happen. But the thing is it accelerating? Is it decelerating? And how long can it go on? That's because that's not a sustainable kind of plan, such as
Okay.
it were. So we enter into
Let me ask you this before we
24.
get to that.
Yep.
We had the D's Fed meeting, and I'm sure that the Fed and his governors also see what you see. Maybe they look at it differently.
Look at it
But
differently.
you know, a very important part of the year to keep consumers confident, wasn't it? Right before Christmas, where people have taken their revenge vacations in the summer and taking on huge debt, record consumer debt,
Yeah,
and
you see
just
it.
to
I mean,
get,
you
yeah,
really saw a blowout in consumer borrowing.
yeah. I mean,
And is
isn't that
that
on it? It's afterburners now.
well, yeah, you could, I guess, it depends which side you're on, right? You could say, ah, that is a sign of huge confidence. We're reaccelerating. Or you could say it's afterburners. It's a sign of desperation. They're trying to maintain spending that they are used to, but can't afford. Uh, and and which one is it, right? So that's why um, stuff like credit or some inventory stuff, it could be read either way. Is it building because nobody's buying stuff, or is it building because the managers are so optimistic about what they're going to do that they want that inventory? And that's where having good leading indexes, which have indicators away from those measures, you want to see if they're corroborating it or not. And in this instance, look, there's no reacceleration in sight. That's the tug of war that's going on. And so I think that that's the story of 2024. How is that going to end? I'm telling you that the cyclical forces are still pushing to the downside. Non-cyclical are pushing back. Who's going to win? How is that going to play out? How long can the non-cyclical push back? Can they do they have any more gas? Can they accelerate the non-cyclical to offset the cyclical impulse to the
Well,
downside?
hasn't the Fed tried to repeal the nature of cycles many times in the last,
Yeah, and I'm not
10,
even
20
sure.
years?
Yeah, and I don't even know if that's a great idea, to tell you the truth. Look, I'm not wishing for recessions in the sense like I don't
Yeah,
want harm to anyone.
yeah,
There's collateral damage to the most vulnerable in
right.
those situations. Um, on the other hand, in a free market oriented economy, it's a feature, it's not a bug. You're supposed to have recessions. They do positive things for the health of the economy in the longer run. It sets it up for its next phase of growth. And so if you skip that part, it's going to cause probably more extreme situations down the road. And that's one thing that I would question about a policy which starts with any recession is the end of the world. It isn't. So going into just reading the tea leaves, reading the cyclical tea leaves, I'm going to say that the market's kind of priced for perfection. We're gonna stick the soft landing of some sort, and inflation's going to come down toward the Fed target and kind of hang out there. That's the basic backdrop that the market's trying to hang on to. Um, so in looking for the risk to that, on the growth side, I'd say, whoa, I think the risk is still to the downside because of this tug of war we just described. And mind you, when the cyclical impulse is still to the downside, that's when your immune system's a bit compromised, and you're more susceptible to negative shocks. And there's plenty of them that are floating around. I don't have to list them all. We'd be here all day, but uh, kind of looking at some of the things being fired at our Navy in the Middle East gives me a little bit of pause. Then on the inflation side, uh, I do question this idea. Look, we've said inflation is in a cyclical downturn. Fine. And then that continues. And I think when I was getting on the call, you're talking about the next CPI print. Yeah, it's probably going to be weaker. That trend will continue. I don't think you're going to see a break in trend anytime soon, not imminent. Having said that, our future inflation gauge, which looks at inflation completely different than the Fed. completely different than a lot of inflation forecasters. We're not extrapolating the recent past. So the expectation that inflation is going to keep falling or go down to the target or whatever and hang out there is based on it coming down over the past 1, 3, 6 months and
Right.
extrapolating that into the future. That's fine as long as inflation isn't cyclical. But my entire career of research, building on that of my mentor, uh, concludes just the opposite, that inflation is cyclical. So it's very dangerous to extrapolate the recent past of something that is cyclical and say, therefore, it won't turn. I think that's a
Okay.
dubious prospect. So looking at forward-looking indicators of inflation, not extrapolating, looking at leading indicators of inflation, what turns ahead of cycle turns in inflation, those indicators came down and they continue to go sideways. It's over a year they've gone sideways. And when you kind of decompose recent parts of the CPI and look in there, the thing that sticks out, you don't have to look too hard, is wage inflation.
Oh, you're talking
And
about the completely phony index, CPI?
well, you could call it that too. Look, I mean, I'm gonna be nice and say everybody's trying to play fair and trying their best. But you're right. It doesn't comport with what we all experience,
Right.
right? And so I think that is a real thing, but it is what it is, and it's what we have to play with. So we're looking at the CPI and what it's constructed, what are the ingredients going into it. And it's wage inflation is sticky, and we know why, right? Again, it's because there's been this structural knock on the size of the labor force, which has uh, there's a lot of backdraft from that.
Yeah.
And when we go into what's going on with employers, they continue to do labor hoarding as long as they can. They're pulling every other level. The work week is way down. It looks recessionary. Temporary jobs growth way down. Looks recessionary. Part-time versus full-time. It looks pretty scary. Then you look at a classic stuff like where are the jobs that are growing? Well, they're easy to see. It's in education and it's in healthcare. And that's growing in 2023, that was growing at a 4% clip. The thing is, that's non-discretionary services.
Right.
Anything else where you have kind of a choice, it's super weak. And the rest of the job market is pretty darn weak as a result. One place where you would have had, I think, negative jobs growth in 2023, which we didn't, was non-residential construction. Typically, that would slam down pretty hard. But if the government steps in and says we're going to support the
Yeah.
building of factories all over the place, then
Right.
you're going to employ people to do that, and that happened.
So
And
very
continues
different.
it continues to happen. The thing is it's not accelerating. In
Okay.
fact, it's decelerating. Sorry,
Okay.
go
All
ahead.
right. So I mean, so these are things that I mean, can you say that this is rear view mirror stuff that may be underestimated what how long this was going to be postponed because of these one-offs as you described lasting?
Yeah, yeah. I
I
think
mean, you're human, right? I mean,
yeah. So leading
we don't,
indicators. So I mean, either there's going to be some sort of shift in the narrative to the downside
yeah,
toward what the cyclical indicators had said, or um, they got the slowdown right, but they didn't get the magnitude right, right? It didn't go
right,
into recession. And
right,
so, and I think the culprit, right? Ever since the reopening, uh, on your show, I'm sure, and when you consume and look at analysis, there's all these record breaking charts
yeah.
to
You're
the
talking
upside
about,
and the downside, right?
yeah,
They're just like either to the moon or straight through the floor. And that is all I think, pretty closely related to the violence of both the lockdown, where so on your charts, all your activity and employment numbers just, they go to -20 or
Yeah.
something, right? And
Right.
then when you have the opening up, even without stimulus, it would have popped. Okay. So then you throw a lot of turbocharged fuel on fuel on there to turbocharge it, and it just went bonkers. And you throw on their supply chains and all that, and the labor force being constrained, and this is what we get. So these indicators, I think, have done a very good job, and their strength has always been direction. Magnitude, that's a secondary kind of conversation. And so
Right.
that's the difference between, hey, we had a sharp slowdown and we had a
2-year
recession.
recession. Yeah.
Yeah. So I think that's a thing to keep in mind.
Speaking
I want
about,
to,
go,
yep.
you wanted to show something? Because
Yep.
I do want to cover when you talk about one-offs. Do your leading indicators have some type of presidential cycle
Hmm.
pattern to them? Because I know we're having an election, and it's,
Yeah.
well,
I've dug around on that.
maybe
I'm
will.
gonna go all the way back to like the 90s and stuff, because when we were at Columbia University at the business school, we had a researcher once, a kid, not a kid, a young man,
Yeah.
who was studying that and wanted to look at that with cycles, and we couldn't find. First off, in our leading indicators, implicitly, look, if they go out, let's say the administration goes out and spends, $5 trillion, it'll show up in the indicators, right? Because there's market prices in there, there's confidence numbers, survey data in there, so it'll show up. Okay, so to the extent it's going to impact the direction of the cycle, implicitly it'll show up. But what we found when we tried to look at all our cycle stuff and see how it linked up with um, elections, presidential elections, slightly different statement. What we what came out of it was that if the coincident index was higher, the level. Right now, this chart I was showing you for a different reason is growth rates. But if the level of the coincident index is higher than it was at the start of the previous downturn, then the
Okay.
incumbent wins.
Okay.
So that's going to be really tricky with all the stuff that happened with COVID. But up until then, that had been the relationship, and it kind of echoed. You may recall, Dale. I don't know about everybody else. Reagan, who had a slogan, and he's like, "Are you better off today than you were 4 years ago?"
Yeah.
It's an echo of that, right?
Okay.
But shown in the data here,
I think there's a
it
small percentage of people that feel that way. Like it gets to be smaller and smaller, I think. Really, don't we
yeah,
have
the
a
upper yeah. If you have a lot of
bifurcated
assets, you're doing
economy?
fine.
It's like a tale of two cities. It's the best of times and the
Yeah.
worst of times, and the people in food lines and
No,
sleeping in their cars, let them eat cake.
I hear you. And the other thing that's pretty scary, right? And this happens
And
in
these are during good times,
yeah,
supposedly.
these are look, I mean, I don't know how much. I thought $9 trillion in debt was a lot, and now we're at 33 or 4.
Yeah.
So for me, I'm like, this I'm like, okay, I am prepared to be surprised by that number going up further. But I think there's I don't want to get political at all, but there's a lot of change, right? The world is changing. When you have, it's not like this east-west world that we used to have a half a decade ago. It's a
Yeah.
more
It's bipolar
cohesive,
now.
holistic. Yeah, and so you have that. Maybe some of the, it's China versus U.S. instead of USSR versus U.S. There's some of those things shifting, and then there's the technology shifting. I'm
Yeah,
sure it was
AI.
I'm guessing it was really disruptive to go from agrarian to industrial.
Yeah,
It's been pretty disruptive, right? We've gone from manufacturing to services.
right.
Then we're kind of sliding from services to information services. And then who
I'm a
knows how
I
AI
I'm a
floats into this.
hologram. I'm
Yeah,
really
you're a
not here.
hologram. I'm a hologram, right? I mean, yeah, no, if you start going down to like, what's going on in physics and quantum mechanics and stuff, you're like, yeah, we're all holograms. I don't know. We're not going to go there. But here on on the on the current state of affairs, this is like if it's possible to have an honest referee. Okay, I know
Yeah,
we all watch. Some of
because
us watch sports or whatever. We're like, hey, that's not fair. That's a
yeah,
bad call. But
too
look,
much laundry on the field. Yeah,
yeah. So look, this is the coincident. I'm really getting back to basics. This is the coincident index growth rate, and so it includes the indicators that define the economy outside your window and how
yeah,
is it doing. And that's we've said it before, but it's all kinds of production measures like GDP and industrial production and things like that. All kinds of employment measures, the headline numbers, the unemployment rate, different types of aspects of basically what's going on with jobs. And then sales numbers, much broader than retail sales. It includes that kind of stuff, but manufacturing, trade sales, really big national sales numbers. And then finally, income numbers. What are all these enterprises and individuals earning? What are they pulling in? So that taken together is what is our economy. That's how we define our economy. That's how we know if we're in an expansion or a recession. It's not simply GDP. And so I know, for example, well, so here, let's just get some highlights out of here. We almost went to 20% growth rate coming out of COVID.
right.
Okay. That's a big number. Okay.
It's
Everything's
historic.
going to get everything's going to get slammed and crazy. Okay. So then we're sliding down. We get to this low, and in 2022 there was a hard landing kind of priced in, right? And we get to this low of say 1% or so, just about here, of all output, employment, income, and sales. And if you'll remember back here, there were a couple of negative quarters, I think, of GDP. Okay. Then we cruise along. We're getting a lot of jobs growth in here, and we get a blowout GDP number here. Okay, and this is where all the stellar jobs growth was happening. But look, to my eye, and we could debate this,
Flat.
yeah,
It's an
languishing. I don't know.
EKG of a dead man.
I don't know. And when you tell me, whoa, we did deficit spending like we did in a recession during this period. I'm like, oh, yeah, I'm not sure if you got what you paid for, right?
Interesting.
Um, so so this is that cyclical impulse to the downside, not even looking forward in our indicators. This is just the adding up of that data. So I'm not cherry picking. I'm not saying, oh, I'm only going to take the things that are going up. There's four big items. They're in there. We have not changed anything about how that's run. And that is the way, that is what the economy is outside our window. So the question here is, okay, is it going to keep languishing? Is it going to deteriorate, or is it going to reaccelerate?
Doesn't that depend on whether or not we've made a pivot with the Fed and they start taking rates down again, Lakshman? Or will it this time be pushing on a string?
I think I don't want to underestimate the power of the Fed or the federal government to get in there and give it a boost. As I said, post GFC during the whole QE stuff, I was kind of surprised with the amount of getting to Q eternity and all this. And so now we are a little bit, you could see it. I haven't really gotten into the weeds. I don't do too much with the Fed. I kind of predict inflation and growth, and then I say, that's going to force them to do something. But if you look at a few of them, the Fed heads have been out the last couple of days, and I think they've tried to talk down a little bit on the cuts, and then they've also focused people in a bit on the reverse repo and stuff like that. And so this unwinding of what they did in the financial plumbing is at hand.
Yeah.
So if your view is that we've stuck the soft landing, implying some sort of acceleration, right? Because you're pivoting, or no landing, we're still growing, or we're going to grow more. Then, as a policymaker, you have to say, yeah, let me get rid of all the emergency stuff I did, and let's not worry so much about inflation because everything's Goldilocks. Our indicators are saying we don't see a reacceleration in this line. And separately on inflation, we don't see this huge drop in inflation, and that's tied to wages really hanging in there. One of the ones I watch a number of different wage indicators, but one of the ones you could watch is the Atlanta Fed. It's a coincident indicator, wage tracker, and so it hits a high of like 6.7 or something a year and a half or so ago, and it's down. It came down to like the low 5% growth rate, and then it's kind of flattened out for 4 months. And
Go ahead,
yeah,
Lakshman. Go ahead,
I was
finish
just
your
going to say,
thought.
and if you open the paper, a lot of businesses have striking workers.
Yeah.
The leverage is there
Yeah.
for the time being.
Yeah, unions haven't been this active in many, many years, and they all won. They all
Yeah,
got what they wanted. And,
yeah,
I'd say my biggest takeaway from what we've talked about today is the fact that even though the market is getting some good numbers on CPI
yep,
and PPI, you're seeing inflation not really declining, but holding. And perhaps, just like the 70s, we have another burst of it. There were more than one inflationary episode in the 70s. There you go. So
yeah,
maybe we're just coming out of the first one from 1970, and then we had a year it cooled off, and then
yeah. The black
74.
line, yeah,
Yeah,
that black line is your 70s inflation.
right.
And so I think the one thing it demonstrates
Three, a number of
is that
completions. Three.
it cycles. You
Yeah,
see, look, we are in a completely different economy. I know all of the objections about why the economy today is not the economy in the 70s. My point on this chart is different. It's that inflation itself, the story behind it can be different in each cycle, but inflation itself is inherently cyclical.
right.
And so where are we? That's always the question. Where are we, right? So here's our gray line is the 2020s. And so we've had this huge run up, this spike up to 9 something percent inflation. And then now we've fallen down to between 3 and 4. And the
Higher
expectation
highs,
is that,
higher lows.
well, the expectation is we're going to go down to 2.
Yeah,
We're going to go down here, and then we're going to stick it.
yeah. It's going to
And,
flatline.
and I'm just like, okay, I think you can hope for that, but I don't see why it must do that. And when I look at forward-looking indicators, not these indicators, this is just the referee, the coincident data. When I look at the forward-looking indicators, they came down,
Yeah,
anticipating this decline, but then they've gone sideways. And that means this is not apt to decline down to 2,
right.
or certainly not to stay there. So I get worried about higher lows. And remember, it's hard to remember, but think back. Arthur Burns is working in here. He's in the early 70s.
Right.
And there's a real trade-off in the public's mind between inflation and jobs, right? You want to have your cake and eat it too. You want a lot of jobs with no inflation.
But you have your dollar that you're earning means something.
Have your dollar is so you get you're in this tug of war. By the end of this period over here, when
10
Volcker is in
years.
there,
Yeah,
so
10
Volcker's
years.
in there. The difference between Volcker and Burns, one of the things, they're very different people, but one of the things to understand about them is they had a different public perception of inflation. When
So who's
Volcker,
Powell? Who's Powell? He wanted to be
well, he wants to be
Volcker,
Volcker. He said, I want to be Volcker.
but he's
But
acting like Burns.
well, with this last piece,
Yeah,
with December meeting, he's a little more Burnsian, right?
yeah,
And
he is.
so part of it is that public pressure from the outside, or from Wall Street, that nobody wants rate
The
hikes,
White House in an
or the
election
White
year.
House, all of them.
Yeah. Okay, so
So everybody's talking their book. Our book
right.
is look, I think this thing is cyclical, and so I'm not going to bet that it just keeps going in a straight line down.
All right.
I think that's the
You know,
main point
if
of
we
it.
ever had a bottom in the oil market, that would happen. But you know, I've heard it people say that there's inflation, deflation in the things we own, which right now isn't happening because if you own stocks and you own real estate, there is, you know, they're going up too. And the inflation is in the stuff we use that you
Food.
always have to replenish
Yeah.
so you don't run out. And you know the grains have been under pressure since, and they're starting to turn up. There are commodity markets that were out of favor. Food prices could be the next part of it, I think, Lakshman.
Yeah, I agree. And I think when I look at 2024, we are seeing some kind of tentative signs of cyclical bottoming in Europe.
Yeah,
Uh, and we are seeing we're on the watch for some cyclical bottoming
in
in,
China.
yeah, maybe in China, but it's more broadly in global industrial growth, which has
Okay.
been really taking it on the chin. And it's quite extreme in the sense that in the wake of COVID, the amount of time of that downturn has been pretty significant. So it's about time that it would start to bottom. And so we're seeing some inklings of that, which could begin to support something like oil prices, but that could take a little while.
Yeah, yeah.
Okay. That
All
could
right.
take a little while. So those are some possible pivots, but all that kind of stuff is not great for the Fed.
Okay. So, and if the dollar turns south, Lakshman, we had a strong dollar regime. It's recovering
It's
now, but it's
inflationary.
still, yeah,
Yeah.
nominally at least.
This and to be clear, we've just been talking this morning about cycles, which is looking out a few quarters. Structural stuff is quite different. Um, if we don't have a recession, right, or a hard landing, because those can help bring prices down more. Um, you've got your onshoring, you've got your tight labor supply, you've got all kinds
Issues.
of issues that are structural. You don't have the China price you had post GFC, where they exported disinflation.
Right.
So without those kinds of things, higher lows in the inflation cycle, that's not a stretch.
Here's the headline of the interview. Lakshman says inflation is not dead, only taking a rest.
It took a
Right?
cyclical rest, a
Yeah.
temporary. What did the transitory? What did he call it? Powell called it
Oh,
transitory.
yeah,
Yes.
transitory. Well, I'll tell you what, there's never been probably a more important time than what happens this summer or fall in both the economy and stock market to determine the
Dale,
fate of our country.
Dale, they are, and right now, the Fed with the pivot in December and the ECB are signaling, hey, yeah, we'll be cutting later this year.
Yeah.
No problem. And I just want to keep an eye on that inflation cycle
Okay.
because if there's no recession, then it probably fuels the inflation cycle to the upside.
Yeah.
On the other hand, if there is a recession, then that's a whole other thing to think about.
Right. Well, you know, it was great catching up with you,
Yeah,
Lakshman.
you
And
too. I'm glad to touch base with you at the beginning of the year.
yeah, and I hope 2024 is a outstanding year. Your best year ever in all ways for you, your family, your coworkers.
I really do appreciate that, and the same to you. And hopefully we can, just learn or improve riding these waves.
Okay.
You
Get
know,
your
and
I'll get my
staying
longboard
engaged.
and
Yeah,
we'll head out. All right, Lakshman.
longboards are safe.
I
Thank
I
you.
I recommend people that you follow Lakshman
Yeah,
at the business cycle and go to
businesscycle.com
yeah,
or you can pick us up on LinkedIn and there's a newsletter.
yeah. Especially if you own a business and that these things are going to be important for how you know, what kind of position you're in if and when certain things happen. Do you have a lot of inventory? Should
Hmm.
you be trimming some of your labor costs? Lakshman can help you out with that. I appreciate it, Lakshman.
Thank you, man.
All right.
Bye
Okay,
bye.
everyone, that's a wrap. I hope you enjoyed. I had a good time. And you could join the team in 10 minutes on the Morning Edge. Adios. Interesting and excellent interview with this guy. I love Lakshman. I'll see you guys.